So Philip, tell us about the excess earnings model.
So the excess earnings model is used to value the primary intangible asset generally in a business. So in a retail business, that might be the brand. In a manufacturing business, that might be the customers. And it's an income-based approach. So it's based on forecast future earnings from that asset.
Okay, so in this model that you have here, you use a 10-year forecast period. How do we determine which forecast period to use?
It's looking at what the expected revenues generated by that asset are. So for customers, it would be looking at what the expected attrition profile is and how that unwinds over time. For something like a brand, in a very well-established business, we might be using a very long forecast period because the brand's expected to continue to trade for a very long time. So the first input is the revenue that the asset is going to generate. So for customer relationships, it would be the revenue that the customers on the transaction date are expected to generate in the future. And you might need to think about the churn in that customer base and applying an attrition rate for customer relationships. And the information to get that attrition rate will likely be available in due diligence documents or in the business's own internal records. The next item to consider is the EBITDA that those customers will generate. So again, looking at what the EBITDA margin those customers have historically generated is and what it's expected to be in the future. You can apply that to your revenue to get your EBITDA. So the next step is to take off depreciation. So if we're valuing customer relationships, for example, we'd need to make an allocation of total business depreciation between the existing customers and the new customers.
And is depreciation likely to be significant?
It can be. It depends on the industry. So a manufacturing business, for example, with lots of fixed assets might have quite a high depreciation charge, and you might have to do quite a lot of work to arrive at an appropriate allocation of depreciation.
Okay.
The next step then is to take off tax. An important thing to think about there is if there's any changes in tax rates in the future, you'd need to incorporate those in your forecast model.
Or if it's overseas?
Exactly. If it's overseas, you might need to use a blended tax rate or the tax rate of the country where that intangible asset sits. So the next step is to deduct contributory asset charges. And we need to deduct those because we're valuing the intangible asset as if it were the only asset we're looking at, the only asset we owned. And it's an economic concept rather than an accounting concept. So if we only owned this intangible asset, we'd have to borrow in all the other operating assets in the business to generate our return. And the people who owned all those other assets would want a return on their cost. So a good example is machinery. In our EBIT, we've got depreciation on machinery, which just unwinds the cost of the asset over its life. But if we didn't own that machinery and someone else did, they'd want the cost of the asset and they'd also want an extra return for lending the asset to us. And that's what the contributory asset charge is. It's that extra return because we're assuming that we don't own the other assets in the business when we look at our intangible asset in isolation. And one of the things you'll notice is that we take a contributory asset charge for the acquired workforce. The acquired workforce obviously isn't on the balance sheet anywhere as a separable intangible asset, but it is an economic asset which contributes to the earnings of the business. So because we're looking at this on an economic basis, we need to take a charge for the workforce.
And are those contributory asset charges likely to be significant in the valuation?
Yeah, they often can be a significant adjustment to the business EBIT. For example, in a manufacturing business, again, you might have lots of fixed assets, so quite a high contributory asset charge for the machinery. In a professional services business, you might not really have many fixed assets, but you might have a big workforce, and so you'd have quite a big contributory asset charge on the workforce. So it really does depend on which sector of the business you're valuing the intangible asset is in.
So how do you calculate the contributory asset charges?
So to calculate the contributory asset charges, there's two inputs we need for each asset: the fair value of that asset and an appropriate rental charge or economic rate of return on the asset.
And how would you get that, the appropriate economic return?
Again, it will vary from asset to asset, but there's usually evidence out there. So for fixed assets, for example, companies might borrow against their fixed assets. So they already have an appropriate rate of return on the fixed asset, and they could use that in their contributory asset charges.
And for the workforce, how would you get
And for the workforce, we'd often use the WACC as an appropriate return on the workforce.
Okay. And then what happens? You benchmark as a percentage of revenue?
Exactly. We benchmark them as a fixed percentage of revenue. And that means when revenue changes in the forecast, the contributory asset charge moves proportionally. So if we've got customer relationships where there's a declining revenue profile, the contributory asset charge also declines over time.
So you have your excess earnings. The next thing is to discount them. How do we get the discount rate?
So in a transaction, there'll be two good benchmarks for discount rates. The first is the overall transaction IRR, and the second is what the market participant WACC for that business would be.
Okay, so you have the IRR, you have the WACC, but how do you determine the discount rate?
So it depends on the nature of the asset we're valuing. The IRR from the transaction might have, for example, lots of growth in it from new customers in the future, so it might be quite significantly higher than the market participant WACC. But if we're valuing existing customers, which have been in the business for a very long time, we might say the transaction IRR is not really relevant for those customers. They're lower risk, so we'd use a lower discount rate. But it will always depend on the asset in question. And it will also depend on stepping back at the end and making sure the value of all your tangible and intangible assets in the business makes sense.